Welcome to Money Saving Canada. If you're looking to grow your wealth and secure your financial future, investing is a key step.
In today's video, we'll guide you through the essentials of starting your investment journey in Canada, covering strategy, budgeting, and planning. Let's dive in.
Before investing, it's crucial to understand your why. Are you saving for a home, planning for retirement, or aiming for long-term wealth growth? Setting clear financial goals helps determine your investment strategy and time horizon. Instead of a vague dream of becoming a millionaire in the future, set a specific and a realistic goal. It doesn't matter whether this is a short-term goal, to save for a vacation, or for a down payment on a mortgage, or to save a certain amount for future financial independence. You could say,
Okay, I want to save $10,000 in 1 year. How I know this is a realistic goal or not?
well, continue to watch this video and I will explain you how to estimate these numbers. Next, evaluate your current financial health. Create a budget to track your income and expenses, ensuring you have funds available to invest. It's advisable to have an emergency fund covering 3 to 6 months of expenses before you start investing. Canadian provinces and territories have different salaries and tax burden. I will take Ontario numbers as an example. You see on the screen latest figures from Statistics Canada for the average mean salary for full-time employees in a province of Ontario. If you're able to follow 50-30-20 rule, you could invest monthly 20% from your after-tax salary. What's 50-30-20 rule?
Well, 50% of your after-tax income goes towards needs, 30% goes towards wants, and 20% goes towards savings and investments. So let's say you make $5,000 a month after taxes. 50% of that would be $2,500 on needs like rent, utilities, groceries, and insurance. 30% of that would be $500 on wants like eating out, shopping, and travel. And then 20% of that would be $1,000 towards savings and investments. And if you can stick to this 50-30-20 rule, you'll be able to save a lot more money and build wealth a lot faster.
If you struggle to follow this rule exactly, don't give up. Create your own rule. For instance, you could use the 50-40-10 approach. The key is to consistently invest a portion of your income. Invest before you spend. It will always pay off in the long run. About 15 years ago, the Canadian government introduced the Tax-Free Savings Account, TFSA. Imagine you had a time machine and went back to that time. You started investing using the TFSA with the first-year contribution limit of $5,000, which is roughly $416 every month. You decided to invest exclusively in the XIU, an exchange-traded fund, ETF, that tracks the S&P/TSX 60 index. This fund includes the 60 largest stocks by market capitalization on the TSX. As the years passed, the contribution room for your TFSA grew, but you decided to stick with your strategy and continued investing the same amount each month. Over time, this fund delivered an average annual return of 7.90%. After 15 years, your total contributions would amount to $75,000. By the way, today's TFSA contribution room is $102,000, so there's still plenty of room to add more. Now let's calculate how much your investment would be worth today, using a financial calculator. In this hypothetical scenario, your investment could be worth $142,683. This demonstrates the power of consistent investing and the magic of compound interest. Earlier you asked, how do I know if saving $10,000 in 1 year is a realistic goal? 1 year is a short-term goal, so let's break it down. Simply divide $10,000 by 12 to see how much you need to save each month. $833.33. If you can manage to save this amount consistently, your goal is realistic. If you're using an account like the EQ Bank HISA, you could even save a little less, around $816.66, since their 3.5% interest rate will help you reach your target. Long-term financial goals calculations are a bit more complicated, but plenty of online calculators can help you set realistic targets. For example, let's say you decide to follow the 50-30-20 rule and invest $1,000 every month into your TFSA or RRSP. How long would it take to accumulate $1 million? Using a hypothetical return of 7.9% compounded monthly, you would need to invest for about 25 years. Interestingly, by the time you hit the $1 million mark, about a third of that amount would come from your own contributions, while the rest would be from interest. This is amazing. Now goals are set. Time to decide how to invest. Consider how hands-on you want to be. Your choices are financial advisors, robo-advisors, do-it-yourself, investing. Sure, you could turn to financial advisors, professionals who provide personalized investment advice. You could ask your bank, your friends, or just search internet and find many licensed financial advisors. Another choice are robo-advisors, automated services that create and manage a diversified portfolio based on your risk profile. Companies like Wealthsimple and Questrade offer these services. Last option, DIY investing. Use online platforms to manage your portfolio. I personally prefer Wealthsimple and Questrade. Beside managed account services mentioned earlier, they provide great services for do-it-yourself investors. Which online broker is better, Wealthsimple or Questrade? In a nutshell, make it simple and start with the Wealthsimple. This platform offers basic services for beginners and very easy in use. Questrade offers more tools and services, but you will need more time to learn. It's great for more seasoned investors. I will come back to a detailed comparison in the next videos. Based on your goals and risk tolerance, select an investment strategy. Every investment carries some risk. Your risk tolerance will influence your investment choices, balancing potential returns against possible losses. Many investments offer the potential for a higher rate of return, but also involve some level of risk. However, the risk may be more acceptable if your goal is longer term because you have more time to recover any financial losses. Your comfort with risk depends on your emotional willingness to accept risk and your financial ability to absorb loss. This is known as your risk tolerance or risk appetite. Options include 1. Conservative approaches are focusing on high-interest saving accounts, GICs, and bonds. 2. Balanced strategies are mixing stocks and bonds. 3. Aggressive tactics emphasizing stocks or cryptocurrency for higher growth potential. Whatever strategy you choose, consistency is key. Set up automatic contributions to your investment accounts, ensuring regular investment regardless of market conditions. This approach, known as dollar-cost averaging, can reduce the impact of market volatility. Regularly review your investment portfolio to ensure it aligns with your goals. Rebalance as necessary to maintain your desired asset allocation, especially after significant market movements or life changes.
Starting your investment journey in Canada involves clear goal setting, understanding your financial situation, choosing the right strategy, and staying consistent. Remember, investing is a long-term commitment. Stay informed, be patient, and your efforts can lead to financial success.
Your goals are set, your strategy is chosen, and the necessary investment decisions have been made. Now it's time for action. Don't forget to like, subscribe, and hit the bell icon for more insights from Money Saving Canada. Share your investment goals in the comments below.